Thanks, good to be here. So I think what we're going to try and do is just give an overview of basically proprietary trading firm formation, trying to cover corporate issues, tax issues, and regulatory issues, among other issues. There's been a lot of changes, both regulatorily and in the tax code, so this is probably a good year to listen to this. I think we'll start with your basic structures for setting up proprietary trading firms. I think the initial one, which is obviously the easiest, is just having an individual trading account in your individual name and starting to trade. Pros are it's obviously easy and there's no admin cost, but there's one very large downside, which is you're now personally liable for any and all losses in the account, whether it's from trading or any other business activities. So we don't recommend that. We generally would want to form an entity, even if it was a single person, and have the trading actually conducted in the entity. So once you decide you're going to form an entity, you need to decide what type of entity. And so your main choices are corporations, LLCs, and limited partnerships. Corporations are really not a good option other than S-corps because corporation has double taxation. So you'll actually be paying an extra layer of tax, which on trading is not exactly a good idea. There is an S-corp option, which I think before there was LLCs, people used a lot of S-corps. We don't really recommend them because S-corps are extremely limited in the types of shareholders that you can have. So you can't have any entity shareholders, and you can't have any classes of stock. It's got to be one class of equity. And so once you go beyond those, you automatically get converted to a C-corp. So because of the limited nature of that, of the S-corp, we don't recommend using an S-corp. So we're left with really LLCs and LPs. LLC is really what we use most often. An LLC gives you the benefit of limited liability like a corporation, but as a flow-through for tax purposes like a partnership. So you have all the benefits of liability protection, and you have a single level of tax, meaning it's flowing through to the individuals rather than having to pay entity level tax. The other main benefit, as many of you know here, is if you're trading futures or you're trading equity options as a dealer, then there is beneficial tax treatment, which Phil will talk about, 1256 treatment. You may know it as 60/40, and if you're a member of an LLC getting a K-1, then that tax treatment can flow through to you whether you're putting in capital or whether you're issued a profits interest. And a profits interest is really an interest in future profits. So you can get a K-1, at least under current law, and retain the character of the gain without having to put any capital in. There is some proposed legislation which has come up every year for the last couple of years that would try and get rid of that and try and tax carried interest, it's called, as ordinary income, and it's gotten a little bit more momentum, but it's still, stuck in proposals at this stage and unclear what it'll happen through Congress. But Phil will go in a little more detail on that. The other bad news is, as if that wasn't enough, you now have apparently Michigan isn't a big fan of 60/40 treatment because there's politicians trying to eliminate carried interest, and now there's some proposals to actually eliminate 60/40 treatment. Again, unclear about whether that's going to have any legs to it. It's been in President Obama's budget for the last couple of years, but it usually hasn't gotten that far. But again, we'll have Phil discuss that as well. But for now, there is a benefit if you're trading and generating significant income to have your income flow through to you on a K-1 and have that beneficial tax treatment flow through as well. The other benefit of an LLC is that you have a lot of flexibility as to how to manage the company, how to split profits, so you can have any type of management structure you could think of, and you could have really any type of economics you can think of. So we often, for our trading firms, we may have equity partners that are splitting the main profits based on whatever split they come up with. We can then have trading members come in and just have a piece of their own trading profits, subject to some of the rules of the exchanges, which we'll talk about later. But it's a very, very flexible structure to allow you really to create economics in whatever way you guys can actually come up with. The other thing that we typically do is we will use Delaware as opposed to Illinois. And the main reason is Delaware, as far as a statutory body, is very clear in what the rules are, and in particular allows you to contractually eliminate or dictate duties that you want amongst the members. So for instance, a lot of times managers don't necessarily want to have fiduciary duties, and in Delaware you can eliminate fiduciary duties, whereas in Illinois you cannot. They have statutory requirements, and so if you're the manager of a trading firm and you bring in a trader and you want to give them the benefit of their trading profits through a K-1, you're not necessarily going to want to be held to a fiduciary duty standard vis-a-vis that trader, so that there's a trader that potentially is saying, well, you should have put all these other trades in this company. In Delaware, you can eliminate that risk, whereas in Illinois, you cannot. So we generally recommend forming an Delaware company. The other alternative is a limited partnership. Generally speaking, we prefer LLCs because the manager or managing member of an LLC has limited liability, whereas the general partner of a limited partnership has unlimited liability, meaning that they're actually liable for the debts and obligations of the partnership. So what that means is no one really ever then wants to be an individual GP, because no one really wants to sign up for individual liability. That's the whole purpose of actually putting an entity in place, which means we have to put another entity in place to sort of limit the liability flowing through to the GP. Now, we used to see this because there was a beneficial tax treatment for self-employment tax. People would try to limit their self-employment tax by using an LP structure. But with the new legislation, the healthcare legislation, that difference is now irrelevant, and Phil will talk about that in a bit. But for now, unfortunately, everybody will be subject to this extra 3.8% tax. So once you pick your structure, let's assume it's an LLC, you now want to decide, well, do I just put everything in there? Do I put all my trading in there? Do I need more than one entity? And the answer is it depends. For a lot of our clients that are generating tangible IP, so let's assume, for instance, you're developing a black box or an algorithmic trading system, that's ultimately going to be a very specific piece of IP. So what we want to do generally is separate different buckets of assets. So if I have a trading account and I have all my intellectual property in the same account, and I have one bad trade and it blows, it will take everything with it, including all your intellectual property. So what we try and do is really separate these assets, set up an IP co and an LLC to have the trading, so that the intellectual property is owned over here, the trading's owned over here, and then we have a holding company that owns both, so that as you make trading profits, you move them up to the holding company, the IP is sitting here protected, and then if you have a bad trade over here, technically that liability will not actually go to the other entities, and so you'll be able to protect the enterprise of your business. You obviously will have reputational concerns and other concerns, but as a factual matter, you'll be able to protect your sort of various businesses from risks to the other. The other thing it helps you with is some people are concerned the other way, that maybe their intellectual property could have a risk of infringing somebody, I don't know, maybe in town somebody's patents. There are general people in town who are very aggressive on their patents. The thought is that if you have a problem with the intellectual property, it will now protect your trading account from actually being liable for a potential infringement claim. So they sort of mutually insulate each other. So that's sort of your basic structure. We also get a little fancier, where now with a lot of our clients that are trading low latency, we'll have servers all over the place. We'll start to put those servers in a separate entity to protect against the tax implications of having servers in multiple jurisdictions, because the servers often are the items that will subject you to local tax. So for instance, if you put a server in Germany because you're trading Eurex, it's likely that server in and of itself will subject you to German tax. So what we'll often do is put the server in a German company, pay a fee over to the German company to actually reflect the value that the server is providing, and pay tax on that, rather than allocating all of the income over to a higher tax jurisdiction. So those are the various structures that we'll put in place. So that's your basic structure, and I'll have Phil talk to you about some of the tax implications and some of the changes that are actually coming up this year.
Okay. Why don't we first talk about taxation of futures, options in a market maker account, currency forwards and broad-based indexes, and stock futures. the taxation of all the products I just mentioned fall under what's called Code Section 1256, sometimes referred to as 60/40. That prior to 1981, there was that futures contracts were only taxed when the contract was offset or when it was P&S'd. And basically what this allowed for were using spreads to create realized losses and unrealized gains. In 1981, Congress, looking at this, created Section 1256 for futures. In 1983, they also included equity options traded in a market maker account. This was the first time that a financial product was ever taxed before it was realized. Or to put it another way, that it was the first time a financial product was ever marked to market for tax purposes. As part of this legislation, that Congress said, well, we're going to give the benefit of the gain on these contracts which are marked to market at year end, 60% long term and 40% short term, and thus the term 60/40. They also allowed for the only capital loss which can be carried back. And a 1256 instrument, one of the ones that I just mentioned, if in a year you have a loss, you can carry it back 3 years, 2 years, and 1 year. Any other capital loss, you can only deduct $3,000 a year, and the balance is carried forward. That if you look at the new tax rates effective January 1st, you would have a blended rate of about 27.84%, or roughly 28%, which is 60% at 20% and 40% at 39.6%. So if you're trading futures or if you're a trader in a trading entity where you're a member of that entity as opposed to an employee, and I think Lance touched on that a minute ago, that your highest marginal income tax rate would be 28%. We could have stopped there a year ago, but also starting January 1st, as part of the Obama health care plan, we now have an increase in tax. If initially your trading income was treated as self-employment income, and basically the code said that if you traded on a membership for your own account, you were a trading professional if you were trading futures. And as a trading professional, that income was subject to self-employment tax, which was basically 15.3% on the first 112,000 and 2.9% on amounts above 112,000. Now we have, under the Obama health care plan, 3.8% for incomes above 250. So if you look at it, the top marginal tax rate now for someone trading regulated futures contracts, options in a market maker account, you would have the 28% plus other 3.8%, which comes to a marginal tax rate of 31.64%. Now, what if you're not self-employed? What if you're just trading not on a membership, or perhaps a limited partner of a trading entity? There's a new Medicare tax, not on earned income, but on what's called net investment income. And this isn't just futures trading, it's stock trading, it's dividends, it's interest, it's rents from a rental property, it's income from any passive investments, if your adjusted gross income is above 250. So either way, Now that whether your trading income is classified as self-employment income or non-self-employment income, your top marginal tax rate is going to be about 32%. When you trade a Section 1256 product in conjunction with a non-Section 1256 product, the best example being you're trading cash treasuries against interest rate futures. That's a mixed straddle. And the way the rules are structured, that you would aggregate the income during a year on a daily basis. If, in most cases, it's an outright gain on the futures or gain on the cash. The net of those two is taxed either as short-term or as a combination of short-term and long-term. If all of the gain was on the derivative, the maximum long-term you could take is 50%. So on a mixed straddle, you could never get more than 50-50. Let's talk about the expense side for a minute, and that's trader versus dealer versus an investor. If Phil Ryan, the accountant, decides to put on a soybean spread 3 or 4 times a year because a client of his said what a good idea it was, he's an investor. If somebody trades every day and their objective of trading is not long-term capital gains or interest or dividends, then they're a trader. The expenses, the ordinary expenses they incur in that trading, they can deduct before adjusted gross income. Again, the difference being the frequency of the trading and the objective of the trading. A dealer, the third category, is mostly associated with broker-dealers, and it's someone that holds inventory which they're trying to sell to customers. The next area I want to talk about is Code Section 475, sometimes called the 475 election. In most cases, you would not make a 475 election if you were trading 1256 products. But if you were trading stock and you were never going to hold the stock for more than a year, then a 475 election is a good idea. What it does is it converts your trading from capital gains and losses to ordinary gains and losses. And those that income is taxed at ordinary rates. What would be the advantage of that? The advantage is you don't have to worry about the wash sale rules, and if you were to have a loss, you could carry that back because it would no longer be a capital loss, it would be what's called a net operating loss.
And Phil, we obviously see a lot of our hedge funds do that, where at the end of the day, they aren't going to hold positions for more than a year, and their investors aren't necessarily investing in the strategy based on the tax consequences or tax benefits. But then for other clients that are trading futures, as you mentioned, or equity options, we typically won't see the election made because that would obviously convert everything over to ordinary.
And with the 475 election, there's a mark-to-market at year-end. That election has to be made in April or by April 15th of the year in question. So if somebody wanted to make a 475 election for 2013, they would have to do that by April 15th. And the other advantage that a lot of hedge funds like is that it eliminates your book-to-tax adjustments. And what a book-to-tax adjustment is where you have a deduction for tax purposes, but not for book purposes. That also as part of Section 1256, the cost of carry has to be capitalized. Pre-1981, there was this tax strategy where that if you were trading futures that had a physical delivery, that you could take a delivery of a contract and the interest in storage which you paid was an ordinary deduction. So through the use of tax straddles, you could wind up with ordinary losses and long-term capital gains. Unfortunately, it was done away with. That Lance talked a moment ago about employee versus self-employment versus partner. And basically that if you're a member of a trading entity, a member of an LLC, a partner of a limited partnership, or a shareholder in an S corp, which you really don't see too much of anymore, that the entity doesn't pay tax, the individual members pay tax, and thus are the term flow-through entity. The income flows through to the actual member or partner or shareholder. That depending on the structure of the entity, it may or may not be self-employment income. If you're a general partner in a partnership, and on the partnership level it's self-employment income, you would have self-employment income. The tax difference between self-employment income and employee income is about half. And that half relates to if you're self-employed, you're paying for yourself and also the employer. As opposed to if you are an employee, you are only paying the employee portion and your firm is paying the employer portion. I should caution that the idea of setting up a trading entity and paying people as self-employed individuals, independent contractors, causes great concern with the IRS. If you control the trader who's working for you, he would meet one of the definitions the IRS has for that person being an employee versus an independent contractor. Coupled with the IRS has made it easier and easier for people that are paid as an independent contractor to later say they should have been employees. And the motivation for them to say that is saving half of the self-employment tax. Do you want to go into the pending issues now, or?
Yeah, or do you want to hear what's coming?
Okay. Why don't we just go over the Medicare?
Sure.
That again, the Medicare is 3.8%. It's brand new this year. If it's earned income, you pay it. If you're married and your modified adjusted gross income is more than $250. $200 if you're single, $125 if you're married filing singly. And again, it's on that if it's not self-employment income, it's on almost every other type of income. Interest, dividends, capital gains, rents, and any passive income. Passive income coming from an entity that you're not active in. So let's say, for example, you're a limited partner of a trading entity. The K-1 which you would receive normally would not show your income as self-employment income. It's still going to be subject to the 3.8% Medicare tax.
Right. So Phil will come back in a little bit on a little more detail on some of the proposals that will affect carried interest in 60/40. I think now what I want to focus on, so we've talked generally about structures and we've talked about the general taxation of financial instruments and whether people are W-2s or 1099s or K-1s. I think so now let's assume we know we're going to form an entity. It's going to be an LLC. Maybe it'll have a trading firm, wholly owned sub. It'll have the IP co, wholly owned sub. So now the question is, how are you going to fund the entity? And there are two real main choices, really, debt or equity. The debt, and let's assume I'm the principal. I'm going to put some money and it'll be equity. And now I want to bring someone else in to provide more trading capital or working capital. So debt, the benefit of debt is it doesn't dilute the ownership. So I still own 100% of the company. I take the debt in. It's not like I'm giving up 50% so that if the company is worth, 100 times what it was today, I'm not giving up 50% of that value. I'm really just have a debt instrument. I'm paying back the debt. I'm paying interest on the debt. The downside is, unlike equity, I actually have to pay back the debt. So if there's trading losses and the performance is poor, I still owe the debt. Now, putting aside whether you could ultimately liquidate the company, et cetera, if I'm talking about operating the business, I'm going to have, periodic payments on debt that I'm going to need to make. And if my performance is stressed, I may not be able to make those payments, which is going to put us in sort of a stress situation. Equity, on the other hand, comes in unless the capital provider negotiates redemption rights. Generally, the equity is in, and there's no requirement to send it out, nor is there a requirement to make periodic interest payments or to make distributions. Now, investors will often negotiate for those provisions, but as a starting matter, you're not required. Again, the downside, though, as soon as I take equity in, putting aside some of the trading deals we discussed, I'm diluting my ownership. So I have to sort of make that bet as to whether I want a permanent equity provider or whether I want a non-permanent debt provider. The thing, though, to think about is, you don't see a lot of debt funding. You really see a lot more in the way of equity. There used to be that a lot of our clients were funded through sub-debt, subordinated debt, and a lot of the banks and brokers used to be able to provide that debt. You really don't see as much of that as you used to, so most of our clients are really looking for capital providers these days. So let's assume we're going to form an entity. There's going to be multiple partners in, and let's assume that Phil and I want to start a trading firm, and we're both going to bring our trading expertise. Maybe one of us is better on the trade side and one is better on the quant side, but we're going to form a company together. The LLC agreement for that company, in my view, is pretty much the most important legal document you're ever going to create. Because that LLC agreement is really going to dictate, if we are successful, who has a claim on the profits and the goodwill of the business. Also, what that LLC agreement really needs to do is set the rules of the road between Phil and I as to what are our respective contributions to the firm, what are our respective duties, as far as time commitments, as far as non-competes, as far as non-solicits, as far as who owns the IP, and then, as far as what's the exit. If ultimately I decide and say, hey, Phil's a lot better at this than I am, and I sort of figure out that maybe I'll just sort of let Phil run the show, and I'll go sit on a beach and sort of wait for Phil to send my check. Phil's not going to feel great about that. He's going to be unhappy. He's going to say, well, you didn't, fulfill your obligations to work for the company and create value, and I don't want to have a partner that's not really contributing have 50% of the business. So it's important to set the rules of the road on the buy-sell provisions so that if there is sort of a breakup between partners, we have a well-documented provision. I'll go over that in a bit in detail. But really, this agreement is the most important agreement you can put together if you're starting a firm. Because if there are lawsuits in the industry around regulatory violations, there's lawsuits around labor issues, non-competes, but the lawsuits that are ultimately about the company, and we all know the lawsuit only comes when the company's profitable, because if it's not, no one's spending time on a lawsuit. Those lawsuits are the ones that actually go on forever, because then you're really getting into what is the company worth, what is the buyout provision, and once you're in that mess and you don't have the rules of the road set, the only ones who actually profit from that are the lawyers, because it's a lawsuit that just keeps going. So what we like to do is set the rules of the road at the beginning and be very clear between Phil and I what the deal is. I'll give you an example of some of the things that we like to think about in the LLC agreement. We want to know what are our obligations to contribute capital. Maybe Phil's got a lot more capital and I'm bringing really my expertise and services, so it may be that Phil's obligated to put X dollars in and I'm obligated to really provide services and continue to devote all my time to the company. So first is how much money comes in. Second is how are we going to split profits? What's our percentage? And again, it can go as easy as 50-50, or it can be, Lance, you're going to do a little more on the trading side, so I'm going to let you have 70% of the trading profits. But you know what, I'm really going to be in charge of building the value of the firm, so maybe if we ever sell the firm, it's 50-50. And I can have any type of profit stream I can cut up and any different way. I mean, we had clients, Phil knows what I'm talking about, where they will have a split on operating profits, they'll have a split on trading, they'll have a split on capital profits, they'll have a split on exchange memberships. So we had clients that had exchange memberships that increased in value exponentially and had a different split on they ever sold the exchange membership. So whatever you guys can come up with, we can usually create a split on, subject to some tax issues. Go ahead. Yeah.
And from a tax standpoint, you can use any allocation method you'd like as long as there's economic substance to the allocation method. An example of economic substance would be Lance and I set up a partnership. He puts the capital and I do all the work. There's economic substance to that split. That Lance brings his children in that contribute no capital, contribute no efforts, and they're allocated a profit. There's no economic substance to that allocation. And the other nice thing about LLCs versus some of the other entities we've talked about is that you can create different classes. And where this becomes relevant is you have a trading entity and that's set up as an LLC. Lance and I started it. One of our traders comes out to us who's now being treated as an employee and says, gee, you guys have had the benefit of 60/40 now, I want part of that. And since we don't want to lose the trader, we would make him a member of the LLC, but he would be a different class of member, a Class B or Class C, and they would have much less responsibility and many fewer rights than the Class A members would have.
Yeah, and in fact, they may have actually more responsibility just because the argument would be we're giving an interest in return for services. So the Class B in this case could typically, if Phil and I started it, we'll have our duties vis-a-vis one another, but the Class B member may have full employment duties, full restrictive covenants, non-competes, non-solicits, and a different split maybe on their own trading. And we'll get into, you have to be careful with certain exchange rules, especially the exchange across the street, because they have a lot of rules, and we'll get into why. But generally speaking, under current law, Phil and I can create an equity instrument that can slice up profits for the most part in many different ways. The other thing that you're going to want to think about is management. So Phil and I are going to run the firm. Who controls day-to-day activities? Do Phil and I need to agree on major decisions? I've seen LLC agreements. A lot of people, they'll just draft LLC agreements. You'll get a form LLC agreement. They'll say, hey, this is great. You two are the managers, and you need a majority of the managers to, quote, run the business and make decisions. Well, it seems fine, right? It seems like Phil and I should agree on everything. But, if Phil's going to, pay the Culligan Waterman, I really don't want to have a board meeting technically to approve that payment. And so what you find out is people start violating the terms of the LLC agreement because the rules aren't really set. And once that happens, then you really call into question, when do Phil and I have to agree and when do we not? And when disputes arise, that's when we have problems. So what we like to do is be clear. A typical situation is, Phil and I are both managers, and so we'll have a list of anything day to day we can do without agreeing on it. Then we'll have a laundry list of here are the things that Phil and I need to agree upon. So that, again, we understand the rules of the road as to what we each have responsibility for and what we have to get consensus on. Two managers is more difficult because if Phil and I don't agree, we have a deadlock. And so we have various ways to break deadlocks, going to third parties, Texas shotgun provisions, or often the idea is, hey, if we don't agree, then we don't do the action. When you have three managers, it becomes a little easier. You're able to get a little consensus. 2 out of the 3 managers decide. So it's not like one partner has a deadlock or a blocking right. The other thing to think about is the duties. So are Phil and I each committing to full-time business activities? Do we have fiduciary duties vis-a-vis one another? Do we ultimately have to indemnify the company if we do something wrong? And then restrictive covenants. Phil and I probably have a confidentiality obligation vis-a-vis the company. Non-disparagement, should have a non-solicit, and then the big question is, do we have a non-compete? So all of the rules of the road really need to be set, because the next thing that's going to come is, well, what happens if we violate these provisions? And so I think generally you want a buy-sell provision that covers every possibility where Phil and I could no longer be at the firm. And so the main reasons would be, Phil resigns, I'm fired for cause, I'm fired without cause, depending on whether the LLC agreement allows it. You have death, you have disability, you have bankruptcy. All reasons where the general premise is we're both splitting 50-50 because we're both going to provide services. If one of us is no longer going to do that for whatever reason, it's generally fair that the other partner is able to buy the other partner out. And this is usually at the beginning. So we will have buy-sells for all of these different reasons. Typically, if you're no longer providing services because it's a bad reason, like removal for cause, that purchase price would be much lower than a purchase price which says death or disability. The other thing you want to be careful about is the purchase price. People used to just say, oh, fair market value, that seems absolutely fine, and let's go with fair market value. And there's more lawsuits over what fair market value means in the trading and asset management arena than really any other arena. Because as you guys know, we had a lot of people in 2008 claiming that volatility and other trading firms were worth 15 times trailing 12 EBITDA, and then it so turned out that the next year they were worth 3 times. So having a general sort of view of fair market value, let's go to an appraiser, is really a dangerous provision because you're what we call playing the appraisal lottery. On any given year, that valuation could be off, and it actually could be. Think about it this way. Let's assume Phil and I are actually doing amazing, and we are a firm that's worth theoretically 10x. Well, until someone writes me that check, that gain is unrealized and it's theoretical. So if Phil agrees that, yeah, if you leave, I'll buy you out of 10x. So that's great. We just had an unbelievable year. The firm's worth $150 million, and so I said, this is probably a great time to leave now. Take my $75 million and walk. Well, it just so happens the firm may be worth theoretically $150 million, but it's only got $20 million of capital now. So how is Phil going to finance my $75 million buyout when he's only got $20 million of capital? It's almost as if the more successful we are, the worse the remaining partner is because of the price. So, we tend to try to avoid, the appraisal lottery, but even trying to come up with a formula because, as you guys know in this business, one year can be very different than the next. And we try and buy people out at book value, capital count balance, because really in this business, until someone has actually written the check, all discussions about fair market value are theoretical and speculative. Now, that said, I have a lot of clients that say this to me. They say, well, listen, if Phil's put in 5 years and he's ready to leave because I can't force him to stay forever, do we think it's maybe unfair to a founder to actually now have no value attributable to the business? And so that's another consideration which says, all right, maybe after a certain period of time, there should be some valuation. There we'll typically come up with a formula, and we'll use a modest multiple. So a multiple that really says, all right, there's some value here, but we're not going to go with a very large multiple because we're still setting this multiple arbitrarily. So we'll use a 3x or a 4x multiple. We'll tend to want to smooth it out over time because, again, I had a miraculous event where we had a bunch of our clients had all these retirements after 2008 trying to price off the high. So what we try and do is we'll look forward and back. We'll maybe look 2 years back. We'll look 2 years forward. We'll smooth out. We'll have an average. And then we'll apply our multiple to avoid people trying to sort of game in time. And then we'll allow the firm to pay out over time so that even though that may be a large number, the remaining partner doesn't have an immediate cash crunch where now they can't even trade anymore because all their capital is going to be tied up in buying out a partner. So to me, the buyout provision is extremely important to really set up the rules of the road so that the remaining partner or partners understand what the deal is. I think the last thing to think about is whether dispute resolutions, how are we going to resolve them? We're going to go to arbitration. We're going to go to court. There are pluses and minuses of that we can talk through. But again, your LLC agreement is ultimately going to be the governing doc of a business that hopefully everybody will build to be extremely profitable. So with that, I think maybe we'll go back into some of the proposed legislative changes. Bill?
Yes. The only thing I can add to what Lance said is that we see problems come up in terms of a sale. That it just seems to bring out the worst in people. In fact, I like to say there's two scenarios that cause problems. One is an estate where somebody dies and somebody's fighting over the estate. The other one is where a firm is being sold at a large premium and people are fighting over the allocation of that premium.
Yeah, when people do poorly, you know, you don't see a lot of losses because people aren't spending good money after bad. The losses come up when you do really well and people want more.
There's a couple of pending issues I want to talk about, and one of them Lance touched on, and that's carried interest. Carried interest has been that basically all carried interest is you're allocating profits in some way other than based on capital. You know, that Lance and I have a partnership. I put in the capital, he does the trading, that to an extent that Lance has a carried interest. I have a venture capital firm. I'm the general partner of the venture capital firm. I get paid a fee. That fee is being allocated to me via a profit allocation as opposed to an ordinary expense on the books of the firm, a carried interest. A real estate partnership where there's a general partner in the real estate partnership where he's managing the properties and he's being allocated profits as opposed to being paid via an expense for the entity. Now, that if you were talking about ordinary income, it wouldn't make any difference, but you're talking about allocating long-term capital gains. So if I'm getting the carried interest, that up until January 1st, I was receiving income that was being taxed at 15%. Post January 1st, it's 20%. And what the critics of carried interest are saying, that the general partner will not receive long-term capital gains. He'll receive ordinary income. Coupled with, it'll be subject to self-employment tax. And number three, the partnership cannot lend him money to put in his capital account to be able to get his allocation on a pro rata basis. You know, we haven't been as concerned about carried interest over the last few years because so many industries were critical of it. But again, we keep hearing more and more about it. But what gives us more concern is the attack on Section 1256, which is the next area I'd like to talk about. That as Lance mentioned, in the president's budget the last few years, he has proposed doing away with 60/40 for trading professionals. A couple weeks ago, the chairman of the House Ways and Means Committee put out a proposal, and his name's Dave Camp, and he's a Republican. And this proposal is titled Financial Products Tax Reform. It treats every derivative as ordinary income. It does away with 60/40, not only for trading professionals, but everyone. And it would mark every derivative to market at year end. And if the derivative was part of a straddle, it would mark both positions to market. That there's some other areas of the proposal, which I'll talk about in a minute, but what concerns us about this proposal is that it's coming from the chairman of the House Ways and Means Committee. And if we saw major tax reform either this year or next, there's a good chance that this proposal could be part of it. His argument in terms of proposing this is first off blaming derivatives for a lot of the problems we had in the 2008 debacle. You know, all of us who sit in this room know the problems were a lot more than derivatives. In fact, if we had more time, I'd give you my opinion on who caused a lot of the problems. That his other reasoning behind this proposal is that he wants to create a system where all financial instruments are taxed uniformly. So if a swap contract is taxed now as ordinary income, by taking a future and taxing that at ordinary income, they would be playing on the same field. That the other part that concerns me, but may work to all of ours advantage because it would be too hard to implement, is that the average person, not a trader, the average investor, he owns a share of stock. The stock has appreciated, he sells some calls against the stock, he buys some puts. Under this proposal at year end, the investor would not only have to mark the short calls or long puts, or long calls or short puts to market, but they would also have to mark the stock to market during the time that it was hedged with whatever the derivative is. This is going to be pretty complicated. Then, as part of this mark to market, you're going to have to find a fair value to mark the position to market at year end. Equity options, no problem. Broad-based indexes, no problem. Exchange-traded futures, certainly no problem. But when you start marking some of the more esoteric derivatives to market for tax purposes, it's going to be pretty complicated. And swaps would be the best example of that, and some of the over-the-counter derivatives. Every year, I'm asked the question, do I think that 60/40 will go away? As Lance can tell you, and any of the rest of you that have been at these seminars the last 3 years, when I'm finally pushed, my answer is always, I'm not worried about it because we have the best government money can buy. This proposal, more than any other in the last, since 1981, gives me great concern. Also, as part of the proposal, if I could just go through a couple of other items. Right now, for investors, if you sell a share of stock, you can identify which shares of stock you're selling. If you bought CME stock, for example, at $50, at $55, at $60, when you sell stock, you can pick which lot I'm selling. The lot that I bought at 60, the lot I bought at 55 or 50. That under this new proposal, you would have to average those. Then it also enhances the wash sale rules, where right now, if I sell a stock at a loss, or any security at a loss, and I buy it back either 30 days before or 30 days after, I cannot recognize the loss, thus the wash sale. That under these proposals, that would also apply if if I sold it in a related account, my kids' accounts, an entity that I have control over, a trust that I have control over, or a retirement plan. So nothing good comes out of this.
All right. So I think the last thing to talk about is really some of the regulatory issues involved in setting up trading firms. The first thing really is, because it's probably applicable to many people in the room, is some of the exchanges have very specific rules. So we've talked about this idea that says, yeah, I can split up your profits however you want, no problem, can do an LLC. Well, that is true from a corporate and tax perspective generally. But again, certain exchanges, especially the one across the street, has very specific rules on how you're able to split profits and what impact that will have on member rates. So many of our clients, especially the clients trading high volume, really cannot make any money unless they get member rates. And often they need the lowest rate, so in effect the 106J rates over at the CME, if you're familiar with the category. The CME has a concern about, in effect, the perceived selling of rates, so arcade. So I basically set up a trading firm, I go ahead and I get my memberships, and then I bring in all these owners and employees, and I give them 100% of their profits and losses, and then I take a tick on what they're doing, and I'm giving them member rates. Well, as you can imagine, the CME is not a big fan of that structure, and so that is prohibited by CME rules. In other words, you would not be able to get those rates if you actually set up that way. So the CME has various rules, which I'll go through a little bit to give you a sense of what they look like, but they're pages and pages of rules that are very complicated. So I would just, if you're going to be a CME member or CBOT member or NYMEX, and you're setting up a firm and you do want to be splitting profits with multiple partners, you really need to understand what these rules permit and prohibit. The good news is over the last several years, the CME's rules on certain of these instances have actually been lessened. So they've reduced their share requirements from 8, 12, and 8,000 shares for, talking about right now, member firms, from 8,000 for one of the exchanges, 12 for 2, 16 for all 3, down to 6, 9, and 12. The other thing they've done is when they're looking at bona fide owners, they, for a full equity member firm, they used to require, at least at the CME, $500,000 of capital up. The CBOT used to have 200, and now they both aligned to 250,000. And the rules are getting at really this premise. If I'm a member firm, can I allow other traders to trade my member firm account and the profits, the trading activity gain the benefit of member rates? And so there are some rules around this. So if I set up a firm, well, let me say it this way. If I set up just a single account and I'm an equity owner, then I can go ahead and get member rates on my trading if I'm a CME member. If Phil and I set up an account together and I'm a CME member but he's not, they look at this as a joint account. They look at the lowest level of membership, i.e. Phil would not have the benefit of member rates, and the whole account would not get the benefit of member rates. So what we're typically seeing, though, is firm setup. So Phil and I, with our proprietary trading firm, you know, Phil's a smart guy, so he's developed a black box that trades at a very high volume. And we have to get 106J rates at the CME. We set our firm up, we buy our memberships and our shares, and now Phil and I want to hire another trader. That trader comes in and says, all right, I'm going to trade your account. When that trader trades our account, are they going to get the benefit of the member rates? The answer is generally yes. If the trader's a W-2, okay, and we're not giving away more than 80% of the profits to the trader, then generally that trading activity would be eligible for member rates. If we have a 1099, and it's a 1099 miscellaneous, where we're taxing as ordinary income, again, generally speaking, we don't give away more than 80%, we can get the benefit of the rates. Let's say our trader, as Phil said, is savvy and wants to get the benefit of the tax treatment. So they want a K1, and they want to get the benefit of the member rates on the trading, plus they want a K1 for the flow-through. Well, now additional rules kick in. That trader has to have $250,000 of capital up in order to be eligible, and then that trader can only, again, cannot get more than 80% of the rates. They have a new rule. Well, it's not really all that new, but it's been new for a couple years, which is their team trading rule. So single trader can get up to 80% of their profits, and the firm has to take at least 20% of the losses. And one thing to note is that the split on profits and losses doesn't have to be the same, but it has to be in, again, that range. But now, Phil and I want to hire 2 traders. They trade together, they trade one account, and we want to be able to allocate them the profits off the one account. The CME now would view that as team trading, i.e. 2 traders, K1s, trading off the same account, and would require an extra requirement. So in addition to not being able to give them more than 80%, because the CME doesn't like this arrangement, and I'll explain why in a minute, the rule is that in order for that team of traders to get the benefit of the tax treatment, they have to have an overall split on the firm. So Phil and I, in order to do this arrangement, have to give them a piece of the entire firm, generally based on their capital over total capital. And the reason the CME has this rule is the CME, again, is concerned with arcades and the perceived selling of rates. So team trading to them is really, Phil and I have this firm, we're happy to have all the traders come in, but now other firms keep piling in. Other firms that maybe have 15 traders, they want the benefit of our rates. They try and pile in, and they're technically all team trading, because Phil and I are not going to give each one of them individual. We want to just treat them as one group, and we want to give them a net amount and then they split it up. Well, that's exactly what the CME is worried about, because now you can keep, in effect, pyramiding firms within firms and give them the benefit of the rate. So in order to make this, quite frankly, more difficult, and in their view, something that really reflects more of an overall partnership in the firm, they have a requirement that they have to get a piece of their overall profits of the firm, and you can imagine that makes the deal for Phil and I a lot more difficult. So note that that is an issue, and it's because they're trying to cover, again, arcades, they're unfortunately picking up what people in the industry can view as the most pure form of trading, which is true team trading, where we've got a couple guys that are really trading one account, and we can't tell how much this person makes and how much this person makes, and they're willing to have us allocate them discretionary bonuses because, again, it's not quantitative as to who did what. In a lot of respects, that's the purest form of team trading, something the CME shouldn't be worried about, but they can't really find a good way to differentiate between that type of team trading and the other sort of more arcade-like. So either one will kick in the requirement that says, got to split on the overall firm, and a lot of people are blindsided by this rule, so it's something to keep in mind. The other thing you want to be careful about is, the CME's got their rules, and they're really trying to protect against, again, the selling of rates. But there's really a larger regulatory issue, which is, if Phil and I set up a firm, and we want to try and give 100% of the profits away, and all we're going to do is we're going to take the rate, the cost that we're charged by our clearing firm and by the exchanges, and we add 3 cents on top of that, and that's how we're going to make our money. Does that look like a trading firm to you guys, or does that maybe look like a brokerage firm? And so the issue is that actually looks a lot like a brokerage firm, because trading firms tend to make money based on trading profits, not based on charging their clients more than their cost. So this opens up a whole issue of, if you're not really set up to actually make money off of trading, you may very well be an unregistered FCM or an unregistered IB. On the equity side, same issue. The game on the equity side is not the game on the future side, which is getting the benefit of member rates. The game on the equity side is margin and leverage. And so the game on the equity side is, well, I want to be a JBO customer. I knew I needed to have my own broker deal and have $1 million in net capital. I didn't really want to do that, so I do the same thing. I go into another firm that had the net capital, and I do the same thing and get my profits, and they charge the rate. We then had portfolio margining, where good news is I didn't have to be a broker-dealer, but bad news is, in order to get the real benefit of portfolio margining, I needed $5 million now in the account. And so you saw a lot of these firms spring up to provide this type of capital. But again, if they're not doing it correctly, they're potentially acting like a broker. There was not a lot out on this for a while. Finally, years ago, a case, Tuco Trading, came out, which finally said, hey, by the way, you guys look like you're an unregistered broker-dealer. And now, because of that, the SEC's put out various circulars. The SIBO put a circular out. And so people are now looking at the issue. On the future side, it's the same issue, but you're often not seeing it as much on the FCM, because often people are doing this at the CME. And the CME's rules, again, meant to protect rates, are really going to put in a structure where now, if you comply with the CME rules, you're not worried that you're really acting as an FCM. So you're almost forced to comply with a split. So that's something to be careful about. The other thing that's happened in the industry lately is, a proprietary trading firm is sort of an interesting being, because it's not clearly in any specific regulatory capacity. So if you're a member of an exchange on the future side, yes, you're a member of an exchange, but you're not necessarily registered with the CFTC or the NFA. And on the equity side, unless you're a broker-dealer, which a lot of our prop firms are, again, because of leverage or because they're a market maker, you're also not really registered. So you start to have to analyze the rules, which is, well, am I acting as an investment advisor, or am I acting as a commodity trading advisor? And generally, for a trading firm, the answer is, well, not really, because if Phil and I form a prop firm together, I'm not really relying on Phil's advice, and he's not relying on mine. We're doing, creating a firm together, and we're trading. There's no real advisor in the mix. But what if Phil and I then go ahead, and there's a couple passive investors that want to put their money in, because Phil and I need trading capital. Now we've got passive money in our firm. Well, the SEC would say, you guys now, Phil and I are actually acting as an advisor vis-a-vis this passive capital. And it used to be that the investment advisor law would give us a good exemption anyway. We'd have an exemption because we'd only have at most one client, and we'd be exempt. Well, they just changed the law to get rid of that exemption, and so now, if we have passives and we have a certain amount of assets under management, that's trading, that's asset management parlance. In our world, it's trading capital. We could theoretically have to register as an advisor. So that's something to be careful about. Same issue on the futures side, which really became a big topic at the end of the year because the CFTC, wanting to get in on the action that the SEC created, said, all right, that's a good idea. We want to get more jurisdiction over people too, so we're going to rescind some of the exemptions from commodity pool operators that a lot of people relied on. Again, going after the hedge funds, wanting to bring the hedge fund managers under their jurisdiction. But commodity pool is possibly a trading firm, possibly. So commodity pool, by definition, is a firm that engaged, in the business of acting as an investment trust or syndicate formed for the purpose of trading futures. The important words are investment trust, syndicate, similar form of enterprise. The general position in the industry is if it's just Phil and I and we're trading and we're active, there's no real investment trust, there's no syndicate. It's more like a general partnership. Phil and I are all active traders. By definition, we're not a pool. But again, you have the same issue where you have passives come in, a couple passive investors put money in. Now the door is open where we may be a commodity pool operator, and not only do we have to worry about whether we're registered, but your FCM, Advantage, has to worry about whether you're appropriately registered, because the law will say that under NFA bylaw 1101, your FCM, which is an NFA member, is not allowed to do business with another firm that is required to be an NFA member but is not. So for instance, Phil and I have something that looks like a pool, and we don't have a real good answer for Advantage why we're not a pool. Advantage may not be able to take the account because Advantage is worried that they can't really take the account if we're not appropriately registered. And at the end of the year, when these exemptions got pulled, all of the clearing firms really had to go through and confirm that their clients were appropriately registered. For most prop firms, this isn't an issue, but for a lot of firms, they may have private equity money in. And so once you have private equity investor money, and again, you have a big passive, opens the door to whether they're a CPO or not, or I'm sorry, a pool, which would then require a CPO registration. Now, we are aware that there is a no action letter out there that in a situation where there was a private equity firm invested in a prop firm that came out on the conclusion that they wouldn't recommend enforcement for failing to register as a CPO, but the facts were fairly limited under the theory that, well, that private equity firm has a seat on the board, is active with that management seat, is sophisticated, and is assisting in the development of the trading strategy. Again, they're sort of analyzing the theory of, well, we've just got another active member, not really a passive. So you need to be very careful with having passive investors if you're trading significant futures, because there is a risk that you will have to register as a commodity pool operator. And if you just say, yeah, forget it, I'm fine with that risk, your clearing firm may not be fine with that risk. So it's really something to think about, and it's really become a big issue because the exemption that, again, most prop firms were able to rely on has been rescinded. So that's, I think, the main overview from a regulatory perspective. Usually for a prop firm, you're in a nice category where you're sort of exempt from just about every federal act that might actually apply to asset management or otherwise, but you change your facts a little bit, and you're all of a sudden potentially in 3 new categories of registration. So just something to keep in mind. You have any other thoughts, Phil?
That's it. Maybe we could entertain any questions now.
So Lance, this is sort of going back. It's such a confusing thing, and I'm just kind of starting to get into this. But my question is, say you have an individual trader, and he's looking to set up a futures account, trades U.S. Treasuries, and he wants to open an account. He doesn't want to put his own capital at risk, so he's looking for investors. Mm-hmm. having people, passive investors put up money. My question is, you kind of touched on like subordinated debt versus passive investors and becoming a commodity pool, trying to register with the exchange. It's like, I feel like the exchange has made it so complicated for an individual. I mean, not every person has $500 or $500,000, $1 million to put up to trade their own capital. So trying to maximize rates, minimizing your personal liability, but yet playing, keeping the ball in play and not subjecting yourself to, a regulatory fine and tarnishing your personal record.
Right.
What is your opinion in terms of, the best structure for an individual that's looking to do that?
It's a challenge, I'm not going to lie to you. I mean, because the laws have gotten more complicated. I mean, to your point.
Are subordinated loans, is that completely out of bounds now?
No. First of all, you got to find one, which is not easy. But it's not clear. Okay, the CME doesn't really have a great view on it, nor is it clear from a CPO perspective. But generally, people are thinking, listen, if it really is debt and not disguised equity, so it's debt, it pays a reasonable debt-like interest rate, it's repayable, then generally most people are going to say, well, okay, the CME, there's no equity here, you're not selling rates, it's debt. They're not even care necessarily whether they're getting the benefit of rates, they just want to be profitable enough to pay the debt. So the CME is probably going to be fine. From a CPO perspective, again, unclear, but if it's debt, the theory is that would mean that if I was lucky enough to get Fifth Third to give me a loan, that all of a sudden I'm a commodity pool because I got a commercial bank to give me a loan. So it's not clear, but I think people try to get comfortable. If it really looks like debt, you're probably okay. But we all know it doesn't often really look like that, right?
It's two individual investors that, say you're raising $500,000, they put $250 a piece. Now are they passive investors that are reaping the benefits of you being an individual getting the lowest rate on the exchange where it's,
Yeah, well, it depends what you're paying them. If you're paying them an interest rate, that's one thing. If you're giving them equity or you're giving them debt that really participates like equity, so it's sort of interest contingent on the profitability of the account, that's going to be a problem. That's going to throw you squarely back in the rules. And then you're going to be into, what do I need from the CME's perspective? What do I need from a CPO perspective? So, I mean, from a CME perspective, if you're not the CME doesn't actually care. They don't have a difference between a prop firm and a hedge fund. They hit them all with the same requirements, same rates, same memberships. The CBOT still has a historical difference where if you are a prop firm, you only need one membership. You still need the shares if you want to do full equity, but if you're a prop firm, one membership. If you're a hedge fund, you need 7. So when you start opening up the door to passives at the Board of Trade, at least if you're trading treasuries, then there's a line. I think the CME generally is comfortable with a few passive capital providers. From their perspective, they haven't generally said that's a hedge fund. So you tend to be okay, but it depends how many capital providers you're looking at. You still have to worry about those passives. Am I operating a commodity pool? So the question is going to be, are they really passive? Or are they people in the business that are sort of active and helping me with the business, and I can, really say they're active participants? If they're active participants, you may have an ability to claim that you're not a pool. If they're passive, you're going to have to look to register as a CPO because you're not going to really have a good exemption.
It's just such a frustrating thing right now. I mean, for an exchange that wants to generate volume, obviously, because they need to generate revenue, they make it so incredibly difficult for individuals. To get in and kind of play within the rules, the rules.
Right. Well, it's just equity memberships become very expensive, very expensive, and the CME, they're afraid of the creep. They don't have a good way to say this is fine, but then if you have too many, it's not. And so because they're afraid of the creep of what you're saying, they just sort of have one big rule that captures the whole gamut, whether it's 4 people or 20 people. But you can always become an H, which are decent rates, but they're not the lowest rates. But if you want to get the lowest rates,
that's what I did. I'm an H.
Yeah. So an H is, they're not bad, right? But they're not great. Much better than customer rates. So, what a lot of people do is they'll see if I can make money as an H, and then they'll figure out a way to go finance the rest of the money. And there are some banks that still are interested in the business finance the memberships, which is permissible, so that I can then become a J.
My question was, is just forming like a single member LLC with passive investor, go in, buy the membership, you get the nickel, but now you fall into that thing, it's like, you know.
Right. No, I mean, passive money is expensive from a regulatory perspective. But at the end of the day, you know, a lot of our clients just don't, no, I don't have a choice. That's great. I have my wonderful unregulated firm that has no capital to trade and is getting customer rates. So ultimately, I think a lot of our clients will conclude that if I'm going to really be a larger firm, or I want to get to that, and I need trading capital, and the only way to get it is to comply, then I got to go register. And there's exemptions under the CPO where you have to register, but they have a registration light. So if your investors are what's called a qualified eligible person, you'll have to register, you'll get your 3, it'll be annoying, but then if they're QEPs, you'll be exempt from a lot of the real onerous. So you can sort of do a registration light if your capital providers are of a certain level. But I don't, unfortunately, have a silver bullet for you. Any other questions? Okay. Thanks, everyone. Phil and I will be around after if there's other questions you want to ask. Not in front of everybody. Thank you.
The video will be posted too.